So lesson number 4 is going to be very interesting for those of you who have never met this Mwalimu. My name is Dr. Joshua Aura. I run, or rather, I work at RCM College, where we teach CPA, CPFM, ACCA, so many other courses. I also run an audit firm by the name of Aura and Co, which is based at Havens Court, Westlands, along Waiyaki Way. And that's why I'm passionate with audit and assurance. Yeah. So then this is what you are doing, ladies and gentlemen. I'm now looking at lecture 4, which is professional ethics, professional ethics, professional ethics, and ethical threats. So when we talk of ethics, remember ethics refers to any behavior that you engage in which is acceptable. Yeah, acceptable to majority, all right? Any behavior that you're engaging in, which is acceptable to majority, then automatically that behavior will be good. All right? So you're reading here, ethics refers to acceptable behavior that creates minimal negative impact on stakeholders. All right? So if, for example, you're playing some loud music, of course, there is big impact to the neighbors, to the stakeholders. All right? So anything that you engage in which is not disturbing others, then automatically that will be what here will be ethical. The purpose of professional ethics in auditing is to preserve professional performance and what we call independence. Ladies and gentlemen, remember, we'll never ever shy away from reminding you of the three-party relationship whenever it comes to auditing process. We have the users of the financial statements, the ones who normally appoint us, like the shareholders. That is party number 1. Number 2, we have the preparers of the financial statements. That is party number 2. And then now we have the auditor, party number 3. Now, please listen. Now, you see, the shareholders will come to, for example, UK, open a big business, they put in the investments, they do their contributions, there are million shareholders, they can't stay in that organization to manage it. They will need a few of them in form of representatives, like directors, to run the entity. Now, these directors, chances are they will misbehave. They will want to steal. And that is why now these shareholders are coming up with somebody will be very objective in assessing their work. Somebody will be very independent in assessing whatever financial statements they prepare. This person who is independent is the one we call the auditor. And ladies and gentlemen, if the auditor is not independent, then that would mean that that is unethical on your part. Because whatever you will do, assuming in this case here you will start eating with the directors, you start in this case here a relationship with these directors, whatever you shall do will have a very big harm on the stakeholders, because if you don't do it right, you as an auditor, you start stealing together with these directors, then at the end of the day, the company will collapse. When it collapses, the employees will really be affected, the suppliers, and so many other stakeholders. Then that will be unethical, because whatever you have engaged in as an auditor has huge negative impact on many stakeholders. So we are calling upon, ladies and gentlemen, our auditors to ensure that whenever they get an assignment, they are independent. So independence means what? That you are objective. So this objectivity, ladies and gentlemen, means that when I go to this company to audit them, you see, when I go to audit this company, if, for example, I have a relationship with them, then I will not be able to give an unbiased opinion. If they are my friends, I will favor them. If they are my enemies, even if they're doing the right thing, I will not give them a good opinion. So I would want a situation where my pendulum can swing to whichever direction without me fearing, given the evidence that I will collect. If I'm independent, if I'm objective, then I should be able to give the right opinion. Now, ladies and gentlemen, whenever we talk of independence in terms of audit, we are supposed to remember something very, very good here. Auditors must follow the ACCA Code of Ethics, which includes 5 fundamental principles remembered by the acronym PICOP. The same with CPA. Same. Remember, all these bodies normally fall under what we call IFAC, IFAC. Yeah, so they have the same code of ethics, etc. So always, whenever you hear of ethics, remember here, our cop, our policeman, yeah, like something that's supposed to police you up. All right. So you remember a very important acronym, PICOP. So PICOP, P stands for professional behavior. That we shall always comply with laws and regulations. Yeah, it doesn't just mean laws and regulations regarding auditing. We shall be law-abiding citizens. So if as an auditor, ladies and gentlemen, you're caught with the law, for example, you've stolen, even if it's not from your clients, here you are being paraded outside here like a thief, then there is no way you'll be able to say that, I'm good. So we must always comply with the law and regulations. As we get into these assignments, we must be able to exercise high levels of honesty, integrity. We must be honest and straightforward. Ladies and gentlemen, I know of some auditors who are really very fearful. When you are doing your work, then you come across something. Even if whatever you have come across here is going to be very bitter before the eyes of the directors, before the eyes of the shareholders, you be factual always. You can't be a good auditor if you are always having falsehoods in your mouth, always cheating. We shall always put all our cards on top of the table. On top of the table. That is what we call integrity. We have found this, we think about this, always be honest. You're never trying to sugarcoat anything. You saying it as it is, as is. PICOP. So now we are through with this high integrity. Then we have C for confidentiality. Confidentiality, ladies and gentlemen, you will be able to come across so many things as you do your audit. Remember, whatever information that you come across as you do your audit, that information belongs to your client, not to third parties outside there. All right. So I will be able to keep my mouth shut regarding any information that I come across when I'm doing my auditing. It's called the principle of what here? Confidentiality. If I disclose whatever I come across when I'm auditing, ladies and gentlemen, without the consent, there are times in this case here, the owners of this information can tell you, hey, go ahead and speak about this, then that is okay. If I have prior consent from my client, then I can talk about that. But otherwise, what I've seen normally happening, and I've seen some auditors going to court because of this, you will get a situation where you're given some work to audit, for example, Safaricom. When you go to audit Safaricom, you realize, hey, Safaricom is going to make huge profits, double profits next year, which is about 3 months away. Then you remember, as an auditor, I'm not allowed to buy their shares because when their profits double, for sure, I expect the share price to really skyrocket, go up. Because the shares will have a high demand. So because as an auditor, I'm not allowed to buy shares, in the evening, I go and talk to my wife, tell my wife, you know, we have this 16 million that we had put in the money market fund, for example, at CIC. Let's withdraw that money. You go and withdraw that money, and then you buy Safaricom shares. So she goes ahead, buys Safaricom shares. 3 months down the line, Safaricom's profits have gone up, and now it has been made public through an announcement. So the share price, for example, was 20 because of this great super performance. Then we have now the share price going to 35. Our lady immediately, upon this price shooting up, she sells all her shares. She makes a clean over, say, 3-4 million shillings within a few hours. or within a few weeks. That will be very wrong because number one, you have given information of your client to a third party. In this case, your wife is a third party. And even to make it very, very bad, you've engaged into criminality. You've done what we call insider trading, using information that is quite confidential here to do business out there. It's called insider trading. It's called insider trading. So this confidentiality, I'll be able to speak about it even more because, ladies and gentlemen, at times in this case here, you may go to audit an organization, right? And then when you are there, you hear them saying that, you know what, this afternoon, we are going to bomb, for example, KICC. Directors just discussing, that this is what we are planning to do. Would you want to tell me that you would want to keep that matter confidential and wait until these kind of people who are kind of animals go and butcher so many people with their bombing activity? No. There are exceptions. There are those things that are really of a high public interest, whether I've got their consent. Of course, they can never give me their consent regarding that issue. There are things when I realize they are happening, I will have to go to the nearest police station and then I report. And then, of course, I'll be protected by my professional body, because that is allowed. Although we shall be coming back to that later. Yeah, somebody is saying add volume. Are you guys able to hear Mwalimu? Because I can see my volume is top. Are you guys able to hear Mwalimu very well? Are you guys able to hear Mwalimu very well? Are you guys able to hear Mwalimu very well? All right.
I think now it will be much better now. I think it will be much better now. Thank you for that reminder. All right, ladies and gentlemen, and I continue. Please listen and listen to me very well. P cop, pi for policeman, also cop for a policeman, pi. Pi cop, confidentiality. Then we have O. O is about objectivity. We have to be very, very objective, ladies and gentlemen, in whatever that we are doing. We must be free from bias. This one I've always seen, especially these young auditors we employ. You employ an auditor. He's been in the industry, say, for 7, 8 years, 9 years. You've given him an assignment to go and do an audit of our client who is a hotel, for example, in Mombasa. So this guy goes there, they do like 2 weeks, 3 weeks, 1 month. And then now you realize that this guy has started a relationship with the CFO, who is a lady there. Yeah. And the relationship is very, very serious. So what should you do in that case, listen? Remember, if this is the engagement partner who is going to issue an opinion, automatically there I can read biasness. I can see in this case here my pendulum always swinging towards praising the CFO who will be now the wife. All right? So we shall always be very objective in whatever that we do. We shall be able to eliminate anything that brings biasness in our decision making. And that biasness, normally, as we're going to study here, comes in so many ways. Not about these love relationships. Comes in so many ways. All right? It could be because of what? Yeah, lowball. What we call lowballing. Lowballing. So you went in as an auditor. You decided in this case here to charge a very low fees, what we call lowball. And then now when you start the exercise, you realize that this guy has got like 30 branches. Of course, you knew about them, but because you wanted to win the tender, you underquoted. If you did lowball, it means that all through you will be on your knees telling those directors, please, I'm doing this, but come next year, come next year, you guys please consider increasing the audit fees. Consider increasing the audit fees. When you are on your knees, there is no way you will be able to say they are bad. They'll always keep on urging you, say we are good, we are good. And then next year we shall be able to give you now a higher fees. Lowballing. Also, when you charge a very high fees, there is a fees you will charge. There is a rule of 15% of your total revenue. You can never have one client giving you more than 15% of your total revenue. What do you mean, Mwalimu? Assuming I have got 5 clients. So these 5 clients, one is giving me 10 million, another one 10 million, another one 10 million, another one 10 million. Those are 40 millions. And then now the 5th client is giving me 50 million. So who can do this mathematics for me? What is 50 over 90 times 100? Somebody do that mathematics for me. 50 over 90, because 4 of them are giving me 40. And then now we have one super ninja client giving me 50. So 50 over 90 times 100 will be what? You have to give me that mathematics, really. I need that mathematics. Will it be 40 something? 55.5%. So you can imagine this revenue coming from one client. What do you think will be happening regarding my relationship with this client? I'll be like hero worshiping this client. I will not want this client to go away, because if he goes away, my revenue drops down by a whole 55%. And that is why the code of ethics thought of this and said that try to diversify your clients in a way that not a single client will be able to give you a revenue which is in excess of 15. Like now, this 55.5% is more than 15%. This is a big red flag. You cannot tell me that you'll be objective with this client. You'll not want to lose this client. Remember, as an auditor, whenever you give a bad opinion, clients will always disappear. Most clients, whenever you give a bad opinion, which is called, for example, qualified, could be adverse, or even a disclaimer. We're going to learn about those opinions. But whenever you give an opinion, ladies and gentlemen, bad one, the clients will disappear. So it means that there is no way you would want this person to disappear. So every time you'll be forced your pendulum to swing towards saying, this client B or a client E, who is giving me 55% of my revenue, it's good. Every time you're just kicking good, then it means that your pendulum is not freely allowed to swing to the outcomes, to the various types of audit opinions regarding the evidence we collect. We simply have an interest. It's called self-interest. I cop objectivity. I cop objectivity. I cop, I will never forget that. I cop objectivity. And then, ladies and gentlemen, we have this P, professional competence. You must be willing to study throughout. Like myself, every year, I put in more than 90, more than 100 hours of what you're studying. I always study every time I'm studying. All right? Because I know without really seriously studying, then I will be in problems. So professional competence is where you are required here to always hone your accountancy, your taxation skills, maintain up to date knowledge, and always deliver quality work. When you are professionally competent, then you shall always deliver quality work. So anytime they talk about code of conduct, code of ethics, regarding, in this case here, ACCA or CPA, always we shall remember ICOP. ICOP. P for professional behavior, I for integrity, C for confidentiality, then we have O for objectivity, being free from bias, and then P for professional competence. Are we together, ladies and gentlemen? Up to here, are we together? Please confirm. Are we together? Please confirm. Please confirm. Please confirm. Please confirm. Please confirm. Please confirm. Thank you so much. Now, ladies and gentlemen, then I will be able to continue like this. We go to what we call the ethical threats. Ethical threats. So ethical threats are circumstances that may prevent compliance with the code of ethics and affect your independence as an auditor. There are normally 5 main threats, which you'll be able to remember them using the acronym Mr. SAFIS. SAFIS, very important acronym that everybody must know. For those of you who are doing an internship at Aura & Co, you always know that I'm very, very particular with these acronyms. And I always tell my people, whenever you go to the industry, always keep on singing about these acronyms because I know they help. So this acronym, SAFIS, S for, we have your self-interest, A is for advocacy, familiarity, intimidation, and then we have self-review threats. Self-review threats. They're here, and I'm going to give you this handout. They're here, and I will be giving you this handout. Ladies and gentlemen, please listen, and listen to me very well. I'm going to simply give you a very high-level knowledge about each of those threats. So in talk of self-interest, interest means that there is something that you are earning from your client. There is some way that you are benefiting, and that benefit, you're not willing to sacrifice it. I'm interested in the company. Now, this interest, how does it come? Self-interest. Assuming in this case here, Dr. Aura happens to be having, say, like 10% of shares of Safaricom. It's huge. I'll be a very rich man. May God, in this case here, put me up there, like that, way up there. Great. So if, for example, I have that kind of shareholding at Safaricom, there is not a single day, me as an auditor, I would want to give them a bad opinion on their financial statements. The market will always listen to the auditor. Whenever I give her a bad opinion, then automatically the market will say, hey, I don't want anything to do with Safaricom. The share price will go down and I will lose. So then I would want situations where my 10% shares value is always protected and even goes up. And that can only go up if I become, in this case here, that kind of a puppet that says, without even looking at the figures, without even looking at the numbers, I'm simply saying that Safaricom's financial statements portray a true and a fair view. Portray a true and fair view. So I'm forced because I have an interest there. The interest in Safaricom could also come if Mrs. Aura was, for example, working at Safaricom, especially as a senior manager. This is a lady, perhaps in this case here, who could be getting, like, say, 1 million Kenya shillings. For sure, if I'm auditing them and then I give a bad opinion, the company may easily collapse. You know, many companies collapse on the auditors giving a bad opinion. So the company could easily collapse. Or if it doesn't collapse, the managers over there may say, hey, you and your husband, as the husband is now checking out of his audit assignment, we are sacking you. We don't want you. Who would want to lose, a baby girl earning over 1 million Kenya shillings a month? I would rather, in this case here, be saying that Safaricom is doing very well so that it can even continue getting, in this case here, more money. All right? That is self-interest. So this self-interest could also come in so many other ways. Yeah, there are some of us in this case here who love gifts. So examples, receiving gifts from clients. I always refuse this. We even have a policy as Aura & Co. We don't accept gifts. Having a personal relationship with key client staff, e.g. your family member working there, it will be a romantic relationship, right? And that is why we tell our people here, please, regardless of how those guys look smart, don't go thinking of marrying somebody from there. Yeah. Look elsewhere. Look elsewhere. But if it happens, I'm going to tell you what happens. You know, in life, things happen. Yeah. So this young man has reached it is his prime time. he has been able to identify somebody there, then automatically he should be removed from the audit team. Yeah. Yeah. Something must kill a man. So in this case, ladies and gentlemen, you should be able to be left. You can't continue with the auditing assignment for that particular client. We can reassign you elsewhere. Being paid a contingency fee or a contingent fee, this really is a big self-interest. And I've always encountered this, ladies and gentlemen, whenever we have tax assignments. Most clients will tell you, like I had one, and I mean, it did even end very well. They'll tell you, we have a tax liability with KRA of 8 million. You've already received an assessment, 8 million. So they'll tell you, we are giving you, for example, some 1 million. Then when you go to the tribunal, try your very best to see how this amount can be reduced. And whatever you are able to save, then we share that benefit. You, the auditor, perhaps takes 20%, and then, of course, the firm remains with the 80% of what has been saved. Brilliant. But you see, now that is a fees which is dependent on a particular outcome, which you as an auditor, you are not in control of. So automatically, then you have a very big interest to start fighting at. It can even make you to think of what year corruption, being corrupt. Because you know, if I give somebody over there, assuming it happens, if I give somebody over there $1 million and then they write off everything, and then I get 20% of now, you see, why are we going to that extent? It's because of the contingency. It's because of the salary, which is pegged on a particular outcome, which is not under your control. That one will put you at a very bad threat. A very bad threat. You should never be accepting engagements like those ones. Yeah, accepting loans. So you come to audit RCM knowing very well that RCM is not a bank. We are not in a business of giving money as loans. And then, ladies and gentlemen, now you tell us, you know what, as I audit you, I want 10 million. Trust you me. As we give you the 10 million, because of course some auditors may squeeze you like that. As we give you 10 million, we are giving it to you, knowing that you shall give us a favorable outcome. So it means that moving forward, you shall never be independent. An auditor can only get a loan from not any client, from a bank that you are auditing. If you are auditing a bank, then you can get a loan from them because the bank is in the business of issuing loans. However, even that loan that you are getting, ensure it is given to you at the normal market rates. Normal market rates, no preferential rates. If they give you at a preferential interest rate, perhaps a very low rate, then automatically there is a benefit. All right. However, what I always tell people, especially when I'm speaking about these two practitioners at ISPAC, because I'm among the lead trainers, ladies and gentlemen, we normally tell our practicing practitioners or auditors to simply avoid such loans. Even if you're auditing a bank, don't take a loan from them. I'm auditing Barclays Bank. If I want a loan, why can't I, in this case here, get a loan from Stanchart? All right. I don't have in this case here to get into that business of getting into a bank, trying to call senior people over there. But there is a loan that I applied for. Why has it not been approved? As you discuss loan matters, somebody will come and ask you, how about that audit? Why don't you do blah, 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 blah? And then we give you a loan. No. What we tell our practitioners is that always as a practitioner, you shall live within your means. You shall be able to cut your skirt according to the size of your cloth. All right? Yeah, charging very low fees to gain clients. It's called lowballing. This will mean that you are really interested in this. Why do you charge a very, very low fees? It's because you are so seriously interested in the client. You are so seriously interested in this client, ladies and gentlemen. We are moving on very well. So relying on one client for more than 15% of revenue, already have explained this. Safeguards. How do you safeguard yourself as an auditing firm? How do we normally safeguard ourselves as a run company from the self-interest threats? Number one, do not accept gifts unless clearly insignificant. Actually, the best is just to avoid any form of gift. Like personally, even tea. I can't take tea at my client's premises. Yeah, why? Because as an auditor, as I told you in the morning, you need to really feed well before you start going to audit. Yeah, because as I told you, ladies and gentlemen, you are accountants, you work with these auditors. Are we really the very best of friends? Accountants and auditors, are we the very best of friends? I mean, ladies and gentlemen, the kind of discoveries you're going to make in that organization are a high level. You're going to stand really on very serious hot wires. You can easily be poisoned. All right. So even if it's like a business, normal items being given to other employees, I shall always consider myself as an auditor a special person. I shall not, in this case here, take a few things here and there. Dr. Aura, now we have this vehicle for you. No, I'm happy with my small vehicle. After all, a vehicle's job is to move me from point A to point B. We shall pay for you. Another person told me the other day that they're going to book for me at Masai Mara these hot air balloons. I don't want them. At my age, how will that excite me? Something taking me up there and then returning me back? No. So I should be contented with whatever small that I have as an auditor. Yeah. Yeah. I should be contented with whatever small I have as an auditor so I don't start getting gifts. All right. So safeguards, remove team members with close personal relationships from the engagement. Once in this case, ladies and gentlemen, we have the engagement team that is going to meet these people at a hotel in Mombasa, to order the hotel. First of all, I would want them to declare. Everybody must sign that self-interest. Yeah. Yeah. Declaration form, you sign that I do not have any conflict of interest. I don't have any personal or family or whatever relationships with members of the audit client. Yeah, that's good. But you see, as I told you, as we move on, things happen. You may start seeing somebody, you may start seeing somebody's eye rolling all over. Then you realize, hey, so no problem, don't sack them, but remove them from this engagement. That's a safeguard. Because we'd want the team that is down there to ensure that they are really objective. You can't be objective when you're chasing somebody around there in your client. So now, ladies and gentlemen, we look at, when you look at the safeguards here, do not charge any contingent fees. Don't charge any contingent fees. Never accept that. Only accept loans from banks at market rates. That's what you write in your exams. But in practice, we don't accept people to take loans. Avoid lowballing and ensure fee diversity across clients. Then we have what we call self-review threat. Ladies and gentlemen, I'm coming to audit your company. You shall be able to give me financial statements. I start with the income statement. I look at the sales figure. The sales figure, perfect. Sales, perfect. I look at cost of sales, no worries. I reach a taxation. So perhaps you had contracted me as your auditors to look at your tax issues. I'm the one who computed the tax figure therein. So you see sales, I'm seeing sales, cost of sales for the very first time. I've never seen those figures. So it means that I'll be able to dip and get more evidence to be able to substantiate that those figures are correct. Because now I'll be very skeptical. As an auditor, I'm required here to have a doubting mind, a questioning mind. I'll be able to question so many things about sales, cost of sales. I've never seen them. But now here I am. I'm the one who computed it, and it has now hit on my desk that I'm now supposed to audit that figure. Who will doubt themselves? Nobody. It means this figure automatically will not even be able. So it's called self-review threat. When you're looking at a figure that you have done yourself, you're reviewing your own work. You can't be objective, because even if you realize that you did some fundamental mistake, who would want to embarrass themselves? Chances are you let that pass. Avoid. And that is why, as auditors, as you shall see, try to avoid non-audit. Non-audit. If I'm your auditor, if I am your auditor today, and then you call me for internal audit services, like at Aura and Core, we normally refuse. Because we see now the advantage we have, given that Mwalimu here has taught for so long, we don't have scarcity of customers. So now we are trying to set our standards very high. Yeah, we are trying to set our standards very high. We don't take non-audit services here for our audit clients. Yeah, but of course, if you had called us for internal audit initially, and of course we do not have any auditor, external auditor arrangement, then I will accept that one. But later on, should you want to onboard me as an auditor, I'll tell you, hey, I'll choose one. We always choose one. That is the concept. So occurs when auditors are reviewing their own work. Examples, an auditor who previously worked for the client, e.g. seconded staff. You see, ladies and gentlemen, even at Aura and the Core, we normally second staffs. Yeah, we have staffs in this case, like we have one big hardware, a Chinese hardware at Mlolongo. So we have one lady, and she was a student here, by the way, Sean. Yeah, Saumu. Yeah. So in this case here, this lady, we have seconded her to that particular hardware. So she's the one who is basically doing the bookkeeping and financial reporting. They don't have an accountant, all right? So then, ladies and gentlemen, if we are their external auditors, the hardware's external auditors, we shall be reviewing the work that we have done ourselves. We shall be able to place lots of trust on Saumu, which will impair our objectivity in terms of external audit services. All right. So an auditor who previously worked for the client, e.g. secondary staff, a staff member who left the client, yeah, they left the client to join the audit firm and then audit their former company. This guy will be having to look at his own figures. Auditors giving advice on accounting, control systems, and then auditing them. That is, well, ladies and gentlemen, as auditors, we shall not be involved in implementing accounting systems for our clients. When you're implementing accounting systems for our clients, you'll be involved in basically producing financial statements. Yeah. Yeah, because you have to do a lot of, things inside there. Yeah. So it means when you'll be auditing, you'll be looking at those figures that you were privy of earlier on, which will be very, very bad. All right. Now, ladies and gentlemen, safeguards. Safeguards do not allow team members to audit work they were involved in. Use different teams for advisory and audit roles. If separate teams are not available, refuse one of the services to preserve independence. Normally, what many audit firms will do, they'll say, hi, hey, you've gotten tax work. You've gotten, in this case here, audit work. Let's do the two of them. But now we're going to build what we call a Chinese wall, big tall wall. So that now we have two engagement teams, one on the other side of the wall doing tax, the other one on this side of the wall doing audit. And that wall is so huge, such that they will never speak between themselves. They'll never talk between themselves. And somebody cannot go up, join the other team. Easy said than done. Trust you me, at some point, these guys will meet and they will discuss. And that is why, as you grow as an organization, you should not be taking two jobs in one organization. Actually, when you take two jobs in one organization, there is a higher risk of that 15% being exceeded, 15% of your revenue being exceeded. Ladies and gentlemen, I'm so sure I'm past time, but are you able to follow? I'm only left with about 5 minutes to finish what I'm discussing. Are you going to give me those 5 minutes? And are you enjoying the session? Kindly confirm there. Confirm there. Can I make a good audit teacher? Unfortunately, I only teach ACC audit. I don't teach CPA audit. I'll be telling you why, but they are the same. They are the same. They are the same. That's why I invite you. Great. Thank you so much. Thank you so much. I finished. Thank you so much. 5 minutes only. We shall be out of this place. Now, so, yeah, critical prohibitions where you cannot put any safeguards. No safeguards, not allowed at all. There are services auditors must never provide for audit clients. Never, regardless of any safeguards. Do not prepare their financial statements for your clients. Do not perform the internal audit functions. Do not design IT systems for the client. All right? All right. So you're told here, these are considered fundamental violations of auditor independence are strictly prohibited. So let me tell you, of course, they are prohibited when you are the external auditor. But assuming, for example, I go to the University of Nairobi, then I get they have advertised 2 jobs, external audit and internal audit. So I'll be able to evaluate between the two. You see, like internal audit will give you regular income, or you'll be able to bill them on a monthly basis. So I'll be able to choose between the two, then use the principle of don't do those 2 jobs in one organization. External audit is very, very critical. External audit is very, very critical. You should not be joining it together with others. So if they want me to do financial statements for them, so they would want to outsource this function, not a problem. Not a problem. Like right now, we are doing that in one of the hardwares in Mlolongo, owned by a Chinese. We are putting up their financial statements, but we are not their external auditors. Don't tell me that now Mwalimu has said that IT will never be done by auditing firms, IT systems. No, what we mean is that if you're the external auditor, you can't implement their IT solutions because you're coming to audit them. If you audit them, then you'll be doing what we call self-review. You'll be doing what we call self-review. You'll be doing what we call self-review. So as I finish, my good friends, we have here familiarity threat. I'm on page number 7. So familiarity threat. So ladies and gentlemen, as you work together with these people for so long, we become family. We become family. Like myself, at times, that's why I like changing. When I realize I've stayed with an auditor for so long, there are firms we normally partner with. Yeah, we tell this firm, take over this client, if the client accepts. Or we simply just decline future reappointments like that. Because we have realized, by the time you're doing like even 3-7 years like that, you really get so entangled with these guys for personal issues a lot. You get one mzee calling you, Dr. Aura, our auditor, my daughter is getting married. Please come and be with us. You can't, not unless you're another one. 7 years of having been with somebody, you can't refuse. They'll call you that, Dr. Aura, now we are buying this land in Kajiado. Come and also become our neighbor here. So you get so much used to each other such that it will reach a point where you cannot want to let them down by giving them a bad opinion. You lose objectivity. That's a big threat. Knowing each other too much is a big threat. Although there are safeguards you can put on that. Now, occurs when an auditor becomes too sympathetic or trusting towards the client due to a long-standing or close relationship, which can impair professional skepticism. Example, friends and family members within the client's management. Long association with the client. Former colleagues now in senior positions are the client. Why is it a threat? Auditors may become too trusting or hesitant to challenge management due to personal closeness or a desire to maintain harmony. Safeguards, personal relationships, strict prohibition. The moment we realize you have a personal relationship with somebody on the other side, then we shall be able to remove you from our engagement team. No audit team member should have a close personal or business relationship with a client. If such a relationship exists, the individual must be removed from the engagement. Long association, engagement partner rule, like ACC is very strict with this. Yeah, in East Africa, not so much. You get somebody who has audited for even 20 years, but ACCA, we have what we call engagement partner rotation. So if you are at Aura and Co, we have 3 partners. Partner A is auditing Safaricom. Partner B is auditing ABSA. Then after some time, we need to rotate. We need to interchange these people. So engagement partner rotation must not serve more than 5 consecutive years on the same audit. Must then observe a cooling off period of 5 years before returning. Once we remove you, having done your 5 years at Safaricom, if you are our auditor, we bring in another engagement auditor, you can't just come back next year. Cooling off period, you cool off. Other partners, for example, these are engagement, these are audit partners. Other partners, e.g. tax or quality review partner, can serve up to 7 consecutive years. Then their cooling off period is normally of fewer years. Yeah, but the engagement, the audit partner, him is 5 consecutive years on one firm. And then when we rotate you to another firm, you can't come back next year. You must cool off things. Employment with a client post-audit. Normally, ladies and gentlemen, what happens, most of our clients take our staff, like I've really suffered out of this. You send this staff to Mombasa, they go and do a very, very good job. And then thereafter, after audit is over, you get, in this case, a young man resigning, telling you now I'm getting greener pastures. So see, next year, we are still the ones auditing the firm he has gone. So we meet him there. All right. We meet him on the other side. There is a policy on that. So employment with the client post-audit, if it's a partner, audit partner must not take employment with a client until a minimum of 2 years have passed since leaving the audit firm. Yeah. A junior person can cross over very easily, but an audit partner, after you leave the firm, you are the one who was in charge of the entire engagement of this organization, but now you have left our firm and you'd want to join that other firm that you have been auditing at top level. Then you must cool off outside for a minimum of 2 years since you leave Aura and Co. Minimum of 2 years. For things in this case that we are auditing to cool down. Yeah, to cool down. Otherwise, you really be able to compromise our being there as auditors. Advocacy threat, as I finish, you can see I'm there. Advocacy, ladies and gentlemen, of course, this is where you become like an advocate, Yeah. Auditors, and I normally assess risks. You'll get so many of our clients who will tell us that, we have got this court matter, and now we are preparing affidavits that please go ahead and sign for us this affidavit. So you're swearing that this person never engaged in this and this. Especially affidavits that we take to the tribunal at KRA. Then automatically become like an advocate. You're protecting some interests now. All right. So once in this case here, you go to the public and say, RCM College is the best, and you are our auditor. In the future, you do your own audit procedures, realize that we are not the best, that there are things that you are doing. It will be very hard for you to start chewing back your words. It will be very hard for you to get outside there and then you start telling people the truth. You would rather now stick with your earlier submission, because we had already promoted some position. All right. All right. So, ladies and gentlemen, we are told here, arises when the auditor promotes or defends the position of the client, potentially compromising objectivity. Auditors become biased, in favor or against the client, as you would want to be neutral. Always as an auditor, you will want to be neutral, because when you go being an advocate over your client, you will undermine your independence and neutrality. Examples, acting as a client's legal representative. That you're going to a court of law as a witness. That is wrong. I shall never do that. I shall never do that. I would rather decline that engagement, that audit. Promoting the client's shares or business to potential investors, you'll get here. So many people will come and tell you that please just sign here and go together with us to this particular meeting, and then you get to defend this particular position so that now investors can have a faith. If I'm not your engagement, or rather I'm not your external auditor, that is a very, very good job. Then I will be able, ladies and gentlemen, to prepare your books of accounts, or even look at your books of accounts as they are. We see what we can add here and there, of course, faithfully. We don't want to do window dressing. And then we even create a very good prospectus. And after creating a good prospectus, I can now join hands with your underwriters and investment bankers. We step on top of that big lorry and go around selling your shares. But once I'm your external auditor, I will never accept to give you any endorsements, never. Because if I give you an endorsement, ladies and gentlemen, there is advocacy there. There's advocacy there. And once I've been able to be your advocate, once I've been able to promote your position, it will be very hard for me to get. You are representing the client in a legal dispute, never do that. Participating in commercial advertisements on behalf of the client, never do that. Safeguards, absolute prohibition. Auditors must not advocate for or promote a client's interest. So long as I'm your external auditor, I will never go outside there to speak about you. Never. If involved in such activities, the auditor must withdraw from the engagement. Once you find yourself in a mess and you've been able to even go on TV and say that this particular client that I'm auditing is really, really very, very good, please, a resignation letter like tomorrow. Litigation consideration. If the auditor is involved in a legal dispute with a client, you've taken a client to court, or a client has taken you to court, please resign. They must not audit the client. Even being asked to witness in favor of the client in a legal or a commercial setting is not allowed. Just being a normal witness is not allowed. I hope that is clear. And if it's not clear, of course, I will be able to give you this video later on, and then you'll be able to listen to it. Then we have intimidation. Remember, we're using that concept of surface. So surface, I've done self-interest, I've done advocacy, I've done familiarity, I've done self-review. Now I'm on my last one, which is the intimidation threat. Ladies and gentlemen, in life, there are those things that intimidate, that scare you. I'm so sure in this group, there must be people who are scared of heights. I'm so sure in this group, there must be a person, if they see a snake around, they can, become crazy. The same case with the audit. We shall be faced with lots of intimidations. Yeah, you'll get in this case here crazy calls. Like there is a farm which is a public farm that we audited some times back. We used to get calls even at 2 a.m. It was crazy. All right. That's why in the subsequent, after we gave them an opinion, the subsequent audit, we declined reappointment, because that is how it's supposed to be. When you feel that you are really under intense pressure, you don't even have to finish the engagement. If you feel it's in lots of undue pressure, you can leave that exercise at the middle. Yeah, we love life. We would want to be killed. All right. So whenever you realize that the pressure coming from various stakeholders is too much, resign, or in this case, give a verdict for this year, but reject reappointment in the subsequent year as their external auditors, as their external auditors. So intimidation occurs when the auditor feels threatened directly or indirectly and is deterred from acting objectively. Why is it a threat? Fear of consequences such as losing the client and associated fees, losing a gift or a personal benefit, damaging personal or professional relationships. Examples, management threatens to replace the auditor. That automatically is a threat, intimidation. pressure to sign off financial statements quickly. They tell you that we need these things, we need to. No, you will tell them, I mean, that is intimidation. That is scaring me. That is scaring me. Threats of legal action or reputational harms, safeguards, similar to self-interest threat safeguards, rotate staff and partners regularly. Yeah, the moment in this case you start realizing that these staffs, they are really under lots of pressure, get them. Our and call will get like 2 of them, take them to a different assignment, you bring new ones. Refuse or disclose significant gifts or hospitality, refuse. Actually, whenever you eat something belonging to these clients, you even put yourself at a very compromising situation. Yeah. So you're supposed to refuse those gifts. And whenever they give them to you, please disclose them to the managing partner. Strengthen internal firm quality control. Consider withdrawing from the engagement where intimidation is very severe. Where intimidation is very, very severe. So, ladies and gentlemen, my name is Dr. Joshua Aura, and I would want to welcome all of you to study, ACCA CPA with us at RCM virtually. If you're interested, you can kindly give us a call. Our number is 0719 525 000, 0719 525 000. And of course, we are so happy because you guys are giving us very serious referrals. RCM, I can see RCM going to 10,000 students. And of course, being an open university, the first open private university very, very soon. Otherwise, thank you very much. Good afternoon. Be blessed. Yeah, I'll be able to share the notes. I'll be able to share the notes in the paid group. Thank you so much. Bye.